So good evening and welcome everyone for this event organized by the Founder Institute, New Delhi, titled How to Raise Capital. The last 6 years in India have seen an astronomical rise in the number of startups. Literally 3 to 5 new startups are born each day in this country, given the quantum of the new ideas that are mushrooming. Most of them are actually thinking out of the box and trying to solve for some sort of a newer problem that is faced by users across different sectors, B2B, B2C, services, and so on. We today have over 72,000 startups, but only a very small fraction of them have received funding. The youth in India are harboring, many of them harbor dreams. You hear of the unicorns and everyone wants to become one. But the truth is that only 10% succeed in building a sustainable business, whilst 90% fail. The biggest struggle that they face, especially in the early stages of build, is when capital is required for product, for technology, for customer acquisitions in the early stages through the sales and marketing efforts, and building capability in the teams. Raising funds is the single most critical and time-consuming activity that an entrepreneur needs to manage. So this topic is absolutely paramount for everybody. To top it, we're seeing a slowdown in the number and size of deals in 2022 as compared to last year. Last year was really the golden year where Indian startups raised over 42 billion USD, 44 new unicorns. This year has been less than half of that. We will discuss that too and its implications for early stage founders today. But before we get to that, let me take a few moments to introduce the Founder Institute. It's the world's largest pre-seed accelerator based in the Silicon Valley that operates in over 200 cities in the world and has helped create 6,000 plus startups till date. The vision of the accelerator is to help create businesses that are solving for key problems that the planet is facing today, most of which are outlined in the UN Sustainable Development Goals. Actually, the problems that we have on the planet cannot be solved by corporates. It's only the nimble-footed startups that can do that. And the corporates are helping in their own way by acquiring or funding these startups. But really, is the youth that is showing the way for the planet to really evolve. The FI chapter in Delhi took off last year with the vision to convert startup ideas into fundable businesses. It's led by me and my co-director, Mr. Gupta. Entrepreneurship is a lonely journey, and typically founders are young minds that are buzzing with ideas. But we help them hone these into sustainable and scalable businesses that can go on and get funded and make an impact in the world that we live in. Our endeavor is to have more and more founders flourish by guiding them through a process of learning with accomplished mentors and through a set of best practices and business tools that can be applied to creating a startup, some sort of a science. We're extremely happy to share that many of our graduates from first cohort have already been funded, which is a testimony to the fact that founders were able to convince investors about their well thought through businesses. So we have today an audience, which is, as we said, young and early stage entrepreneurs who are standing on the anvil of raising capital for their respective businesses. So let's begin by introducing our panelists. We have with us 3 investors today with immense domain knowledge and experience in helping businesses in different domains. And I think that's how we selected 3 completely unique people from different sectors. First, let me invite Mr. Rahul Agarwala, a friend and founder of Sense AI Ventures, who's building a very, very focused fund for artificial intelligence and machine learning based business models. He himself has been an entrepreneur in the same space and has funded many, many more startups in this sector over the past many years. So welcome, Rahul.
Thank you, Anjali. Lovely to be here.
You want to add something about yourself?
Sure. So I'm so excited to be speaking to all of you because, of course, it's been some time, but I was on the other side of the table most of my life as an entrepreneur looking for funding. And I was helped by a lot of people. So happy to pass that forward and happy to take your questions and try and answer them to the best of my ability.
Thanks, Rahul. We'll look forward. Next, we have Neeraj Saxena, founder of Xscale Global. Again, another friend and a B2B SaaS focused, who's building a B2B SaaS focused accelerator and fund and scaling B2B entrepreneurs in India as well as globally. He himself has experience in orchestrating huge B2B businesses in his corporate avatar before he built this accelerator. Welcome, Neeraj. Add a few lines about yourself.
Thanks, Anjali, and great to be here. Yeah, the only thing I'll say that looking for funding, which is the topic for today, and it can be solved in two ways. One is you raise capital from investors. Second is you generate revenues, right? Obviously, it's not true for very, very early stage, idea stage companies, but normally we try to advise entrepreneurs that, hold back your equity, try to grow your revenue. That will fund for the business for itself. So, that's a high level philosophy we take.
Sure. That's the ideal stage where your revenue is sufficient to fund your forward plans, but more on that later. So
Sure.
finally, the third panelist is Mr. Amit Raj Gogia, investor in consumer and health tech sectors, but also more recently Shark Tank consultant in season 2, who has been actively engaged in screening startups to connect with the big sharks on the famous TV show. So welcome, Amit, and tell us a couple of lines about yourself.
Sure, thank you. Happy to be here and pass on whatever I have picked up also as an angel investor. Although my portfolio is small, I did experiment out of my domain of consumer healthcare into EdTech and SaaS in the past. I'll try to contribute as much as possible value add to the participants through this session. Thank you.
Thanks, Amit, for your
Thanks a
humility.
lot.
So welcome all of you. It's a pleasure. So the session is about advising these brand new prospects or prospective founders. So let's start with, the key thing, which is that I have an idea and I want to take it to market. So first thing I need to do is find an investor. And that's how most people approach it. In fact, we get a lot of people who come and say, idea mil gaya, bas ab investor chahiye. And I think that itself is a fallacy. So my first question is going to be to you to say, what's the right stage for the early stage people to actually start talking to an investor or an angel? And what journey should they undertake at their own end before that process starts? I'm going to leave that to Rahul to take.
Sure. So I'll take the first stab at it. So there's the traditional way to think about it, right? Which was that when you're really early stage, which means your idea is literally in your head or on a piece of paper and there's nothing more about it, then the people who can invest in it are the people who know you. So that's the friends and family. And the journey starts from there. So think about this as a marathon, which is run as a relay, right? If you have a very long marathon being run in little stages, your first stage is that your friends and family, people who know you, who invest because they trust you more than the idea, because it's still on paper. Then you build something, you put together a team. The first thing which you should usually do is put together a team, right? If you have a team, that means you convinced a few people to join you in your journey, right? Which means they also believe in the idea that you believe in. And if you get your friends and family to invest, now as anybody outsider, an investor who doesn't know you is an outsider, that gives us some confidence, right? So if you go talk to a stranger and tell him that, see, I was able to get 2-3 people to join me and 2-3 people to give me some money, and I'm now building this, and I've already done this much work. That, and just put yourself in the investor's shoes. It's so much nicer to hear than say, I have this $1 billion idea or $1 trillion idea. I'm going to change the world. That's great. We want people like that, but show us something, right? So typically, to my mind, that's the minimum you should have done. You should have done something more than just having an idea on paper before you come to an investor.
Absolutely.
Sorry, just to add one more thing, I spoke about those multiple stages in a marathon, right? So each stage has a different set of investors. And think of it as a relay race. So one investor, you go to the first investor, then he will take your startup till the next investor, and then the next investor takes, and that's how it becomes bigger and bigger and bigger. I'm sure you've read stories about how Flipkart is so many tens of millions of dollars or hundreds of millions, or Byju's or any of these, but it started much earlier, right? They first raised maybe less than $1 million, then a few million, and then that's how the journey continues, right? And each stage, different set of investors looking for different things. And as an entrepreneur, what did I tell you? The first thing you solved for was that you got few people to believe in you, and that gives more people confidence. That's exactly what you keep doing. Each stage is when more confidence is built. So if you build your product and you have something to show, obviously the investor is going to believe your story and be more excited about investing in you. And the next investor will probably require a little more than that, because now he's going to give you a much larger check. So the bigger the check, the more proof you need, right? And if you think about it in a very simple way, you yourself do things exactly like that. If you're buying a expensive car, you will do much more research than if you are just buying a chocolate, right? So the chocolate, because it's 10 rupees or 20 rupees, you are not going to do research. You're not going to go online and say, compare all the different Cadbury flavors and all the other chocolate brands and which is the best brand I should buy for 20 rupees. But if you're buying a 20 lakh SUV, you will say, which SUV should I go and buy? All of you will do that in your lives. So think like that. So the more the money, the more the proof required, the more the research required.
That's so true. I think the relay analogy is great. And the fact that different investors take you through different stages, both great points. Thanks. What about grants and subsidies? A lot of the founders actually, look for, obviously I've exhausted my personal savings. I've looked at friends and family. Crowdsourcing doesn't really work so much in India. So, that hasn't taken off the way it probably has in other markets. But, if you're left with nothing else, you say, okay, maybe let me apply to every way possible where some grant or subsidy may be available. Would one of you want to take that, Neeraj or Amit?
Yeah. Before I do, I have something to add to the previous question,
Sure.
because as an angel investor, I keep getting bombarded. Although I must admit, I'm not a seasoned guy. I'm sure the other panelists would have gone much through this journey of angel investing. So it's like founders coming, sharing the pitch deck and mentioning that they're still on a full-time job and this is the idea they have. So first of all, that it's a no-go at that stage itself, that you don't have a conviction of going 100%, or there are other instances where somebody is building and they're saying the other co-founder who's actually the techie or the main guy behind running the the venture, the main skills are still with someone who's doing some gig parallelly, but he will come from US or wherever, but once they will get some funding. So that's a red flag for any investor for that matter, as I said earlier, because the team is not convinced to put 100%. So that's something which I wanted to just put out there and mention, that it's not the right stage to reach out, because you are not, first of all, you're actually creating a wrong impression about your concept, or your credibility is getting hit, because you're not showing 100% commitment to your own idea by doing something parallelly. So that's a no-go. What I would want to add as a constructive input for the founders to be for fundraise, they should reach out once they have MVP done. So MVP, like a prototype, has to be there, some validation from the customer pain point, whichever you're solving, whichever sector, you have to have some validation. So whatever it takes, 6 months, 1 year, depending on whatever problem you're solving, you need to go through that on your own. So that's where, as the panelists said earlier, you would need to raise family friends round. That goes without saying. You would need to do that, but do not reach investors outside circle unless you have that. So that would be my my 2 bits to that. Never to do that.
True. So first have conviction in your own idea and prove it and show it before you ask somebody else to do that. Great. Thanks, Amit, for that input. Neeraj, you want to add anything on that?
No, I think Rahul and Amit covered pretty much pretty well on that. I think the idea of full-time founders, idea of running it right like a relay, is absolutely right. Friends and family, angels, micro VCs, ultimately, and you have to follow the chain. Don't jump to Sequoia to raise your pre-seed round, basically, So one of the things, by the way, founders do, they send their pitch deck to everyone on the LinkedIn, basically everyone, without number one checking who is at what stage and what is their thesis, basically, right? Are you a SaaS, consumer, D2C, whatever, but they just send it, right? We have written very, in bold letters that we are only B2B SaaS and tech. We keep getting pitches for consumer as well, right? Consumer, D2C and everything else, right? It
Right.
shows that they have not done any research. They have just, created an email template and, just shooting it out, which obviously is
So-
not going to fetch any results.
So Neeraj, actually that is a segue into my next question, which is going to be exactly this, that mostly they don't know who to talk to for what. So they randomly send stuff everywhere. It's not
Yeah.
just the money, but the color of the money. What can that investor do for you? And would he be interested in you? So can you throw some light on how they would do that research and who to target and when and how? I mean, some sense on how to do
Yeah,
this.
look, absolutely. But look, by the way, they reach out either on email or they reach out on LinkedIn. These are the primary two ways you reach out to investor, right? Apart from one of the instances when I got a cold call for making an investment, I think that has never happened. So, but normally when somebody has a website, a fund has a website, right? Most of the funds have a presence, either in a form of website. At least if you're reaching out somebody on LinkedIn, they have a LinkedIn profile linked to a company profile. If you only read first 10 lines, you will know pretty much that should I apply or should I not apply, at what stage they are, right? And number two, what domain they are, right? So at least these two things have to be very, very clear before you reach out. Apart from few other things, right, which they obviously list, even they say at what stage we fund, post MVP companies, post revenue companies, even you can see, the past investments. Normally they, it's there on their LinkedIn or their own website, past investment, at what stage they have done. Have they done the rounds of, they do a rounds of $500,000. You can go to Crunchbase, as simple as that, right? You can see the full profile, how many investments they have done, what are the size. You are raising 200K, you are going to a fund which has a minimum ticket size of $2 million. Absolute mismatch, right? So stuff like that, right? So, and then the other way around is also true. You're raising a $1 million raise and you're going to a micro VC fund. This is also not a great idea. So basically that research can be very easily done today, right? There are, the platforms there. So LinkedIn is there, websites are there, Crunchbase is there. Anyone can go in and do a bit of research, I'm saying, right? Not a very large amount of research. Said before.
No, and just to add to what Neeraj is saying, so completely agree to those points, right? So size and stage, as well as what domain. Like for example, I only do artificial intelligence, so it may be the world's best idea, right? But I wouldn't fund it simply because I don't fund those ideas, right? Like let's say space exploration, you have built new technology, let's say new battery technology, which I think would be a brilliant business, right? But even while I might believe that, I can't invest in it because that's not my thesis area of investment. So be very think about that. But also, the other thing I'm trying to say is that if you do the research, when you approach the investor, you will anyway do better. It's not just about filtering. Do not use research just to filter, okay, I should do it to Neeraj, should I do it to Rahul? Yes, no. Of course, but when you read my site and Neeraj's site, I'm pretty sure also, you'll find we've written down clearly what we look for. Not only what we fund, but what we look for in the entrepreneur. What is the kind of ideas we like to invest in? Why you'll find posts on our previous investment, especially on LinkedIn, which might explain our thesis that we invested in this company because of X, Y, Z reason. Now, we've actually laid it down for you, right? Because it's in my interest that I save my time by telling you exactly what I'm looking for. If you think you match that, come to me. So it helps you tune your pitch, right? Even within, let's say, Neeraj also does deep tech and SaaS. I will also do AI plus SaaS, right? And so maybe you'll fall into both our buckets. But you might be wanting to tune the pitch differently, right? For example, for me, it might be a more tech-oriented and talking about the IP, because I talk a lot about that on my website. Versus Neeraj, who's more concerned about which markets and GTM. I mean, I'm not making but as an example, you get.
No, that's true.
Yeah. And Rahul, just to extend what you just said, in fact, we picked up, we tried to accumulate list of startups based on AI specifically and send them an invite giving your name as he is an AI investor specifically. So join in, because then that is how the match will happen.
Sure. So so there's a question on the
Yeah,
QA.
there's a question.
Har Pratap says, please advise on grants as a funding option. Would any of you like to take that?
I can give a quick shot,
Yeah.
right? So I think, look, grants is great, by the way. In today's context, both the union government as well as the state governments have came up with a dedicated corpus, right? They are dispersed through dedicated channels or mostly the agencies. So for example, these can be some universities or college. All the top colleges today, all the IIMs, IITs, NITs have a dedicated incubator accelerator, and they are one of the channels to apply for these grants, right? Apart from that, there are a lot of private incubators and accelerators are also looped in, because only IIT, the IIMs cannot fund as 70,000 startups in the country, right? So I think the scale, and there are multiple grants, multiple agencies giving for different areas. So to start with, just to give an idea, the first level of grant, which is available at an idea level, by the way, is a Nidhi Prayas grant, which is a 10 lakh grant. There is another grant, Nidhi, which is SSS, right? It's a 50 lakh grant, right? But it is not at idea level. You need to have a POC before you apply for Nidhi SSS normally, right? But though it's an investment committee, so everyone, there is a chairman, etc. So for example, I come from IIM Lucknow, and I'm advising the IIM Lucknow incubator in some way or form. I'm associated with that because it's my alma mater as well. And then, they have the second grant also. So not every college or every incubator have all grants. So then there is a UP government, for example, have just came up with a 400 crore corpus, right? They have given it through the state colleges in the country, in the UP. Then there are specific agencies like the BIREC, IDEX, Pravartak, who are giving grants for specific areas. Pravartak is towards the core technology side, right? BIREC is more towards the sustainability side. IDEX is more towards the defense side, right? And their grants are ranging from 50 lakhs to 1.5 CR, right? Huge, so a significant money is out there. I give you example, one of our own portfolio startups have till now got 2 CR grant, 2 CR in pure grants. See how much equity they saved, and they were diluting all this, right? The equity, right? And early stages grant, right? At the right stages, you have to apply at the right grant and to get it, right? So they qualified and keep getting, and then we obviously help them advise through the journey. So they got 2 CR grant, they are pre-revenue, by the way, just to give you an idea. So very rarely we work with pre-revenue companies, but that is a pure deep tech company we wanted to work with. Very, very promising. And that's why, we picked them up, we have given them a capital, and after that they got, we advised them on the grant side rather than the capital raising side, because they were pre-revenue and stuff like that. So they raised 2 CR grant. Until now, they have never, in the last 1 year, they did not need to raise any money, because grants are more than sufficient to fulfill their thing, right? So now they will hit the markets sometime later. So I'm giving you this journey that you need to look for these grants and then apply it. They are available. I'm saying a lot many people think who gets a grant, this is all on the paper. No, that's not the reality. At least 3 of our portfolio companies have get at least 1 grant till now, right? So it's there basically.
Well said. Startup India, Atal Mission, our own cohort founder actually got a grant from STPI. So yes, it is real. But yes, you've got to do the hard work to make sure that
the paperwork is there. I tell you one thing. There's a paperwork and the post grant. I would say they don't give in one tranche, by the way. The grant never come like they give 1.5 CR 50 lakhs in one go, or even the 10 lakh is not come in one go, right? You have to file for it, they approve it, you get the first tranche, then will be a milestone, so you have to deliver the milestone, keep getting the tranches, right? It can be time based, or it can be the milestone based, the POC, etc., right? So a bit of paperwork is there. They ask you the MIS, they ask your progress report monthly, quarterly, stuff like that. There is a bit of paperwork involved, but obviously it's a dilution free grant, so you have to do that.
But isn't that true? I mean, a lot of the times founders feel paisa mil gaya, ab life achhi ho jayegi. But you don't realize that the moment you've taken money, there's accountability. because
Very
you're then responsible for a whole lot of information that needs to go back, because they're also expecting returns, they're expecting milestones, they're expecting business evolution. So who would like to talk about, the kind of responsibility it puts on your shoulders?
Just one addition. There is another question that is there any specific grant available for women entrepreneurs?
Oh, several.
Archana has asked this question.
Oh, there are several. That's all I can say. I don't have the list in front of me, but there's so many, especially for women entrepreneurs, especially just for women.
So Archana, let's connect offline and we can probably, connect you with some women-focused grants. But for now, let's go back to this question to say what kind of responsibility should you be prepared for when you take money? Because it's not free money, right?
I can.
Yeah.
Do you want me to take a step?
Yeah,
or?
yeah, sure. Yeah,
Okay,
Neeraj.
I give you a high level because, and then Rahul and then Amit can add. But just understand two parts to it. And I split it into grants versus equity capital, right? Grants also released for a specific purpose, and the money that come from investors is also for a specific purpose. You cannot use it at your whim, basically that, now I got a diversion, initially I thought this, now I thought. You can do that, but you need to especially look. So that's the difference between a private money and the grant money, which is normally a government money. When they give you money, they tell you that, what you can do with this money. So this can go in a product development, this can go in XYZ, right? So one of our startups got a grant of 50 lakhs from BIREC, but it is bucketized basically. You can do it only for this, or this, right? Now they want to take a new product research, but that is not allowed. Only a component of that is allowed to be used for that, right? And then they cannot use any other, component for that. So this is one part. So every grant is, in that sense, they are bucketized. Even investor money, when you sign a term sheet or a DSIA, it is clearly written what that money is going to be used for. Normally, investors are flexible, but you need to provide them enough information at every stage. So some of the things they will mandatorily ask you to provide them, which is like a monthly MIS, it can be a quarterly, a status meeting and stuff like that. For us, basically, we do we are more like a different kind of a fund where we work very proactively with the founders, in the sense that we have a weekly call with the founders. We don't do a post-mortem, but we literally tell them what to do on a week-to-week basis. So we are more like an active VC in that sense, right? Rather than passive VC who give the fund and do I would say reviews, right? We proactively tell how and where to utilize the money and what to do with this, right? But then for other VCs also, obviously they have the monthly and the quarterly rigor is definitely there. And if you are going to use it for a purpose which has not been initially agreed upon, you have to take a consent always in written. Otherwise you may land up in a very difficult situation, right? So these are some of the things, but I'll let Rahul and then Amit add further to it.
So that,
on mute.
Yes,
so that was, I can't agree more with Neeraj. I mean, as investors, it is important for us to exactly understand what you're doing. And in the early stage, especially, you'll find most investors active, especially people who've been entrepreneurs before, they'll come in and help you and guide you with the experience. But more importantly, try and understand what your larger responsibilities. Your larger responsibility is to make the investor money, right? He has given you money not so that you can pursue your idea. He's giving you money because he expects return on that money. It's not a loan. So if you, in case your idea fails, you do not have obligation. But however, the goal for the investor is that he makes money from that investment. So as an entrepreneur, and it's not that I have never failed, right? But when I ever took funding, the first thing I thought is, should I take this funding and will I be able to make it 3 times, 5 times, 10 times, 100 times and return that money to the investor? So he will, he will have benefited for having invested in me. I've benefited because my idea has now become a reality, all of that. So what is the benefit the investor needs to get is also your responsibility to a large degree. You try your best. We can't always, it's never 100%. a lot of startups will fail. We as investors understand that. But what we are looking for is for you to understand the responsibility and put your best effort to give us a return. As long as you're doing that, genuinely, honestly, you've really lived up to your role as an entrepreneur. Results are not the key problem. The key issue is, and when Neeraj talked about those reports, talked about those discussions, those build that feeling in the investor that you've done your efforts. So even when you fail, so there have been entrepreneurs who have invested in, who may not have done as well, or it didn't work out. And but tomorrow, will I fund them again or not? It will depend largely on this, whether they were responsible entrepreneurs, whether they understood their job was to do as much effort they can to make sure I get my money back in multiple times, right? As long as they made the effort, whether they failed at it or not is some amount of luck, some amount of karma, all of those pieces play a part. So hard to say about that, but we can always see the effort. So as entrepreneurs, remember, if you do the right effort and you keep your investors in the loop, you'll find that most of them will back you because they liked you. That's why they invested. No investor just invests in an idea. Right? And fundamentally, actually, in a startup, you can change everything in the startup. You cannot change the founders. The founders are the one constant, right? So for me as an investor, I'm looking for the right kind of founders. Great idea is not enough. Great idea with great founders is the minimum set for almost any investor you'll talk to. He was convinced you're a great founder. You have to keep that faith alive, and you'll find that investors will back you again and again.
So another great question that we usually get is, how much should I raise? A lot of the times we feel कि पैसा मिल रहा है तो ज्यादा ही ले लेते हैं, चलो 1 करोड़ ले लेते हैं, जबकि पता नहीं है, पर कोई बात नहीं, हेडरूम रहेगा, ये 30-40 का तो पता है क्या करना है, बाकी whether बाद में कब मिले नहीं मिले. I mean, there's a mindset of, I'm not sure, should I raise $500,000, 20,000 USD, where should I pitch myself, because I'm not sure where and how I will utilize it when my next round will come. So what can we say to people who are at that stage?
Let me grab it.
Yes, Amit. Yes, Amit.
So it was even just today morning when I was giving some tips to a founder who have traveled all the way from Pune to meet me here on fundraising. And the first thing I told them, keep the runway in the current scheme of affairs where funding winter is going on, extend the runway to 24 months. So till last year, that thumb rule was 18 months. Now it is 24 months. So that is not something which I personally have decided. I have witnessed other investors also giving the same approach, because that is ideal, first of all, to keep a longer runway. And that buffer will always help, to prepare you, the founder, for the next round. So that extra buffer is always advisable. So that's my take on the runway. That's I think is the very crucial aspect for the founder, that they should start raising activate the process of fundraising 6 months before.
Mm-hmm.
So, and keep this much of amount in mind, which they will need to reach to the next level of growth. So it is for them to decide what level of growth they have the vision, which they have blueprint of by way of a deck. So that, of course, vision is customized, is the founder's vision. So that we can't change as an investor, but for whatever they want, they have kept the milestones for, for instance, since I took that example of this startup, so they are in Pune and Maharashtra now. They need for the expansion to now they've achieved the MVP. They want to expand to other states. So obviously they have a milestone for next round. So they had a clear-cut deployment. Kahan pe wo paisa lagega. So that's very good. You need that clear transparency from the others aspect, from the investor perspective, to get conviction. But they that was only my input. The rest was, everything was in sync. That kahan pe lagega, but so I asked them to increase that, by instead of 18 months, 24 months. That's my take.
So you've talked about a runway to be prepared, but you also talked about use of funds, right? So they should be very clear where you're deploying, how much and when and how, right? And that has to be in sync with business plans. So I think that more or less, you want to add anything to that, Neeraj or Rahul?
So I'll just clarify, he's already,
Yeah.
Amit already mentioned it, but
Right.
fundamentally you have to look at it from a stage that relay perspective. It should be enough money to get you to the next stage. What the next stage really is will be unique to each startup. But one, I would suggest you go read Lean Startups. It's a great book on how to do a startup, how to think about the key stages early especially in the early years of a startup. The demand hypothesis, the scale hypothesis. So which other of the hypotheses have you proven of your business? So if you think of a startup as a set of statements you made to yourself saying that people need this product, it will sell, people will buy at this price. These are all assumptions, right? I mean, you think so, you have some data why you believe so, but in the end, it's not proven before you do it, right? So if you think of answering each question as one stage, that is another way to look at it. But point I'm making is think of your business as being built in stages. You're not going to be able to do everything together. So, and that 18-month thumb rule comes from experience of how most stages worked, and 18 months seem to be a good enough time window to have crossed a stage and then spend that 6 months, which Amit spoke about, to raise the funds. Because 18 months means after 12 months, you are raising money, right? Because you need the next round by 18. So considering 5 to 6 months for raising money, you start by 12, 13, 14th month latest.
Sure. I think it's also about how much equity you're willing to or will have to liquidate to get those funds in, right? A lot of founders say, let me raise more, but remember, do you really want to liquidate that much at the lower valuation, or would you rather wait and raise, at a larger valuation? So those are things you got to kind of think of when you decide how much to raise and when.
Yeah, absolutely. This last point, Anjali, just to add, it is very important. I think, other 2 points that covered by Amit and Rahul, I think they covered pretty much everything, but this last point is also important. So, I've been an angel investor for a while now. In my early days, I invested in one of the companies, right? And, at that time, funding was available, right? So they did not, exactly this is the mistake they did. And, by the time they raised 3 rounds pretty quickly, because they were getting money, not because they were needing it. What has happened? The 3 founders are left with 40% only, 60% they diluted. And they have, a very small or very little revenues, right? And then that's where the problem, where is the headroom? And then they went for when a bigger VC, they say, if I take another 15%, basically, what is the skin in the game from the founders? Basically, your 75% the company has gone. Between 3 of you, you will left with 8-9%, and then you are a sub, 2 crore in revenue company, and that's why they refuse them. They said because too much dilution has happened, now you are too risky a bet, because even if you raise 2 more rounds, basically technically you're out. Basically, founders have left with 15% altogether. Each founder will be left with 5%, and this is not enough skin in the game for them for us to put money. So I'm saying be very careful. Too much dilution too early will deter the next round of investors. They want founders to have a decent skin in the game when they come.
Yeah. So another way of maintaining your equity and diluting lesser is to look at other forms of capital, and may not be the first round, but subsequent rounds. And so many new forms of, debt capital have become prevalent in the market today. There's of course basic loans, but there's also things like revenue financing, asset financing, venture debt. I've also heard of, recently in the last conversation, we were discussing community SOPs, just different formats that have emerged to allow founders to retain equity as they raise money. Would you talk about some of the pros and cons of these and when to deploy which and how does it make sense?
I could take RBF, for instance, as I have been recommending that to my, at least the startups who approach me for guidance as a growth capital. And this was not even the case when I was a founder. So this even instrument like the option was not even there as a RBF. The last 5 years, what we have seen now, just for the audience, RBF stands for revenue-based financing. It's a form of financing where you take a debt. Sorry, it's like you're not taking a debt, but it's like if you compare with the bank, where bank gives you EMI irrespective of whether your sale is up or low. Here it is not like that. Based on your sales, so they take a commission or a cut. So if it is not there next month, they won't get any money. So that is how different, and there's no collateral needed. So that is how RBF is a very good instrument or channel to take debt. And this is something which, as I said, was not even an option. Now there are about 10 different companies offering RBF, and it's amazing how fast they operate. They just give a decision within 48 hours. Means that's what I've witnessed to the startups which I recommended, and there are multiple options available. So I would strongly suggest just to keep the audience also informed that this is more so for SaaS or recurring kind of a businesses or internet first brands, internet first marketplace operating D2C brands, wherever there's a transparency and recurring business happening. So it would not work in capital intensive or other business models where there's no transparency or recurring business. Yeah.
Sure. That's an absolutely great view on the revenue-based financing. Would you like to talk about any of the others, Neeraj or Rahul?
Yeah.
Yes, Neeraj.
So yeah, RBF, as Amit rightly said, is mostly for SaaS and D2C businesses. Asset financing, a part of, so look, asset financing, startups don't have a hard asset like a factory and a large machinery most of the times. Asset financing is most prevalent in MSME sector rather than the startup sector, but a small component of asset financing, which is called invoice financing, is still there in a startup. So when you are in a business where invoices are there, and you need a working capital, or churn. Your churn is high. You are raising the invoices but not getting them on time, etc. Or your cycle is like that. You can do invoice financing. Even the SaaS businesses sometimes do invoice financing because they have a kind of a committed revenue. So RBF and invoice financing actually mirror each other in sometimes, right? Venture debt and loans. I think two things. Loans are again from banks, not easy to get. Because they look for collaterals. Startups hardly have assets on their books. Balance sheets are not designed like a corporate where there are a lot of net asset value is not there actually, right? And banks don't value the IP, etc. Right? Even if it's there. So loans are difficult to get, but one should try it based on whatever the case may be. There are some specialized agency, by the way, that are giving the startup loans, right? And one should approach those kind of specific agencies, right? So they can give loans, but otherwise venture debt is there. Venture debt is again an exact form of a loan, means it's a loan but at a higher coupon rate, right? So it's there, and then now it's fairly easily available. It's a substitute to equity dilution, but normally understand that it can put you under high pressure because debt has to be repaid on time. So if you get an option, and then finally the community side, normally again it is available for consumer products. Sometime the pioneer of this was a Pebble. Pebble has launched a smart watch. Actually, it's the first smart. They raised a lot of community financing, and they said, you will get our watch, when we launch it, at a very, very cheap discounted price, right, versus the market price, and a lot of people have participated. So basically, they have not diluted even their equity. They sold their product at a discount even before the product was there, right? So stuff like that. So people have done innovative work. There are some now community financing platforms, not in India, because crowdfunding is not exactly allowed, though it's been done in some way or form. But US, it's there. Community financing is pretty much there. So
there's one in India as well, Neeraj, by the way. Just know of somebody. There's one in India as well now.
No, there are in India, but
yeah, Tyke.
Yeah, Tyke is there. No. So Tyke is not community financing. So okay. So there are two variants. So Tyke is still I would call it as a, so Tyke is there, the another one is there. I think they approached us for funding, by the way, I forgot their name.
Right.
Then there are three, by the way, not one even. Right. So Tyke is there. I know Tyke pretty well. But
Right.
Tyke, you can, if you call me, it's a micro angel platform rather than anything else. So you can invest in a small ticket size, and you have a large number of investors. Everyone comes and sits on your cap table and stuff like that. So it's a micro angel platform. It is not basically a community. They call it a community platform, but it's not a community platform. Community platform or crowdfunding is a slightly different concept. If you look in a
Sure.
US concept, where you take the money from a large number of community. Sometimes it is in exchange of the product. As I said, Pebble was an example. Sometimes it's free money, basically free money, and sort of they give the money as almost like a grant also. So that is a crowdfunding, and then so there are variants of crowdfunding. You're right. So I think in India, Tyke has done a micro angel platform that form now. So basically, you should explore. The whole idea is you should explore pretty much everything, because founder need money and from wherever it comes, right? Many of them may not be applicable to you. So, for example, RBF, asset financing, or loans. Many of the time you may not be eligible to start with, and then even to go with community side. So you need to explore what fits your need, and then move forward.
Also,
Great.
just to add, like for example, venture debt is typically available only to companies that have already raised venture capital.
Yeah.
So most companies will not give you venture debt unless you have raised venture capital. That's one of the key things they look at. So some of these things are correlated. Read up on them. I think you'll find enough information now online. But for companies that can actually build revenue-based financing, honestly, to my mind, is one of the really good innovations and really helps founders build their businesses faster and better with less dilution.
Yeah.
Absolutely, 100% agree.
Great. So that brings us to the next thing. A lot is being spoken about funding winter, right? And the bit of a slowdown that we're seeing in the capital markets. So what trends are you seeing specifically in your domains with respects to shifts in, investor perceptions and their willingness to put money on the table in terms of sizes of raises, in terms of valuations in the recent past? So I'd want all of you to take this in your own way, because I'm sure you're seeing different trends.
Yeah,
Yes, okay.
And from my perspective, what I'm witnessing is at least the funds have kind of postponed early stage by securing the fund for their existing portfolio. So they're just trying to safeguard their current portfolio and making less investments, fewer deals, which is we are all witnessing. It is pretty obvious in the media versus what we saw last year. So the inside take is, of course, why they're doing it. They want to protect their portfolio first. So that's pretty obvious, right? And given the size of these funds are 90% of what the overall size of the VC capital is. So, and I'm talking about the big Sequoias, Blooms, ASIL of that nature. I'm not talking about angel, which is just the contrary, because angel networks, people like, for example, people like me who join as a syndicate of these networks and they pool in money, they come at a different ticket size, just for the audience to be aware. So my comment is more at the late stage. So late stage, yes, there's very less action because they're trying to protect their portfolio, and which is understandable. So early stage, yes, the action is still happening, and that's where different entity like the ones which I was referring, the angel networks, pitch in. So that is still happening, and overall, I look at I think it's gonna stick like this next year as well. So I don't think the scenario is gonna change overnight. They're already predicting recession. And India, although is going to be safeguarded for whatever external factors we don't get impacted and and our domestic consumption is big enough to safeguard us. Pulling in all those scenarios in light, I think we are going to see similar action like this year. So late stage portfolios will continue to invest in their, and early stage action will continue to happen. So it's going to be optimistic for all founders. That's a summary of, I would say, how I would put in. So not to worry at early stage.
Sure, sure. Rahul?
So just jumping in. So completely agree. So let's say we divide the world into 3 buckets, and just there's no science to this, just doing it arbitrarily. So if you look at raising money, which is less than $1 million, then you look at it from 1 to 20 million and more than 20 million. These bucket sizes, by the way, are not great, but and honestly speaking, for most of you out there, you're in the less than $1 million bucket. So actually all 3 have suffered. But when you look at things which are more than $20 million, they have really suffered. The reason when Anjali started this panel, she said that funding is down by 50%, but it's not 50% across these 3 segments, right? And please understand, the bulk of the money actually is always invested in the later stage, right? One deal there is equal to more than 100 deals in earlier stages. So that's where the biggest slowdown is. And as Amit correctly pointed out, funds are saving money for, so, you know, they want to protect their own family, right? The people they've already invested in are the ones they care about. And that is why they will make sure that they give them money, because other people are doing the same thing. So everybody's feeding their families and not really going out and investing in strangers. So one, contextually, you should look at it like that. But for early stage, try and understand, as we talked about that stages and 18 months as one thumb rule. And Amit, in fact, even told you to look at it from 24 months. But startups that raise money today will need their next round of money after at least 18 months. Now, how long will this funding winter, the mood environment be bad for raising money? Hard to guess, but 18-24 months kind of looks like the cycle time to me. Things should become much better. So one, as an early stage investor, my bet is that in 18 months, the scenario will look much better. And thus companies are investing today should be okay when they need to raise their next round of money. But, you know, I'm also advising, when I'm writing checks today, I'm making sure founders are looking at it more from a 24 months perspective and raising enough money for that, and not raising for a 12-month cycle. That doesn't work. So early stage hasn't suffered and will not suffer as much, because the number of sources of funds are much more diverse. This is not one set of one pool of investors may be pulling back, others will put in money. And the quantum of money which goes into early stage actually is a pretty small sum when you look at the larger, out of the 42 billion Anjali is talking about, less than $1 billion would have gone into that less than 1 million rounds, right? So that's 5% of the market. So even when it suffers by a bit, doesn't suffer by much. And quality founders with quality ideas, no matter the market, the worst stage, and I mean, our entrepreneur for now 25 years, worst stage, I raised money in 2002, in like 2001, 2002, which was really bad, right? It gets funded. So do not lose hope that there's funding winter. Funding winter, if you are a large startup, is much harder for you because people are not taking that level of risk. As an early stage person, somebody who's just starting out, do not worry at all. If you have a quality idea, yeah, investors may do more meetings than they were doing last year, may ask you for more data than they were, but that's it. And actually, I think it's a good correction. I mean, from that perspective. And just as an aside about my sector, which is artificial intelligence, fortunately or unfortunately, it remains hot because the number of great AI startups is less than the demand from the investor community, because all investors believe AI is going to be really big. I'm being one of them, and thus I think that statement is very correct. God alone knows. I mean, hard to be sure about the future, but that's what I think. And most of us are willing to put money. So the AI segment remains hot, and you'll find in all markets, there's certain things which continue to get funded because that's the mood of that time, right?
Got it. So Neeraj, as you answer this, please also touch upon how valuations are impacted, and does that impact early stages?
Absolutely. No, I think what Amit and Rahul have covered, most important points. Though, and then what Rahul said, I completely second that. This is not, personally, in my opinion, it is not a funding winter. It is a major correction, which is anyway required. The valuations were unrealistic. If you look, when anything goes beyond fundamentals, and I have been by the way, the listed equity investor for the longest period of time, for more than 20 years, and I have always been a value investor. If you know or heard about Warren Buffett, etc., I followed the value investing models, right? And whenever there is, anything that peaked, I was not the one who was investing. I was holding the money, and whenever it got down to, 2008, I invested a lot of money in the market. When everyone was pulling out, I was investing. Demonetization, when everyone was pulling out, I was investing money. COVID when hit, everyone was pulling out, I invested a lot of money in listed equity market and see, right? And basically, I made a lot of returns on my investment from the investments I made during these, I would say, downturns, right? The whole idea for an investor, especially those who are in this for a while now, they know when to invest and when not to invest, right? So basically, one is called a momentum investing, etc. I won't go in all these details, but fundamentally, what I'm trying to say is this is not a funding winter. This is just a correction which was overdue, and it has corrected, right? Rahul rightly said most of the correction is coming at the top layer. If you compare at a sub $1 million funding, I don't have the data in front of me. Chances are it would not have shrunk by more than 20%. So if we look at the absolute money that has been disbursed in a pre-seed and seed stages, that is a less than $1 billion checks, right? So money has not compressed much here, and I think most of the founders here on this forum today would be concerned about that part, right? What Rahul has rightly said, that the diligence has increased a bit, and which is again a good thing to have. Earlier, the rounds were become pretty hasty. Actually, they everyone was looking to participate in the rounds, closing the round, etc. This diligence has took a bit of a backseat, which has came back like in the past. It was always used to be there. Rounds used to take slightly more time, right? Because everyone used to do their diligence, at their own pace. In last, 2021, etc., and then late part of 2020, I saw hasty investing that, a lot of people have not done diligence, invested money. But I think that has now sorted out. It's back to normal, I would say, right? Where everyone is doing diligence before giving money, which should be the way it should have been always. Right. Yeah. So I think for early stage startups, it's not a funding winter. And that's a simple statement I would like to make, right? I think valuations might have corrected a bit. Earlier, the SaaS founders, I can give you example, they were trying to raise at 25x the revenue, etc. That has corrected now between more like 10 or 15x. Though the similar amount of money being disbursed, that's a part I'm trying to say that, right? It's not like this money is less. It is like the valuation might be slightly different. The diligence might be slightly more, right? And hence you need to be patient with the investors if you are raising the money in this time, that they will do and very well satisfied, then they will enter. So that's the thing. Valuations are realistic, I think. Earlier they were, I think, over the top. So they have corrected basically. And again, I would say rightfully so. So that's my take.
I have a question, which is very close to this, that is there a difference in the investor stance towards the business model per se? So earlier they were more willing to be, flexible for very high burn businesses where, you can put money in, continue to acquire customers, but now saying, hey, build your revenue, become more sustainable, try and build, profitability, a little bit more stress on that. Is that a shift also? So I think that's important for investors, for founders to understand, because when you're building a model, you've got to be more conscious of saying, how soon can I become self-sustaining?
Especially with all the things that are happening with the edtech companies.
Yeah.
This thing is quite important now.
Yep.
No, absolutely. So D2C, for example, is a segment we don't invest, but they got a lot of money earlier on, right? many of them were in cash burn side, right?
Mm.
Versus B2B SaaS, which was never a very high cash burn business because, especially if you are in a post-product stage, they were not a very high cash burn business unless until you are investing very highly on the growth side. Most of the capital was a growth capital for the acquiring more revenue. And the logic is simple that you acquire a customer today, he will stay with you for at least 3 years and you get, your money back multiplied by something, right? So that is the logic. So if you see now the investor focus has been shifted to where what Rahul also said, the AI or technology focused businesses that are not very high burn businesses like the platforms like the D2Cs, etc., SaaS businesses. So
Yeah.
I think that is a flavor of the day. And then that's why we say I don't know, again, I don't have a data, but chances are the funding would have increased in these segments versus last year. I'm pretty sure.
So
Yeah,
as
Rahul.
so as a percentage, as a proportion of the total funding, the shift towards cash flow businesses, which B2B SaaS, I mean, a large part of my AI investing is in B2B SaaS actually. So both, Neeraj and I that way have been, we are now more the flavor of the month than we were last year.
Yeah,
Right?
that's
Sure. No, it's more a B2C trend and clearly, yeah. So there's a question here on the window from Karuna who says, can you explain about Safe Notes?
Safe Notes, yeah.
Yeah, so I don't know, someone wants to go ahead, I can.
Rahul, would you take that?
Sure. So Safe Notes is a simple agreement for equity, right? And this was done by Y Combinator. Y Combinator invented the SAFE structure. It basically said early stage companies trying to make it very complex, the transaction, and negotiating each term was a waste of time, both for investors and for entrepreneurs. So what Y Combinator did was created a standard template of an agreement, which founders and investors could use. And a lot of funding in the US you'll find, and Safe Notes have multiple varieties. And if you go to the Y Combinator site, you'll find those varieties and those differences between them. Those Safe Notes became kind of a standard in the US. In India, unfortunately, that hasn't happened to the extent it should have. I actually like the philosophy with which it's built, and I'm happy to be flexible actually, because you can go take all the rights, and if the business fails, I mean, we would have spent a month negotiating a very complex agreement, and then a lot of those businesses are going to fail. So why spend so much time negotiating that? So that's, from founders' perspective, it's actually very, very founder friendly. I mean, it's a very fair agreement. So as founders, you should try and get your investors to think about taking a safe. In India, a friend of mine has created the iSafe structure. So, Sanjay Mehta, 100X VC has done that. So yeah, you'll find some differences between the US legal structure and how the world works there versus here. So iSafe tries to take care of that. But it's a great, simple document for startups and investors to agree on the terms of the investment. The figures are dependent on the actual valuation, transaction percentage, all of those, but all the other terms reduces the need for a lawyer.
True. And I think in
Just
India, the closest to a safe note is a convertible note, by the way. Right. So that, because look, I think what Rahul said is right. Look, US structure allows a pure safe note. Right. For any agreement, you need to have an underlying law which supports that agreement, right? You cannot actually implement exact Y Combinator safe note in India because there has to be underlying legal backing to that, right? Legal or regulatory backing to that, whatever agreement you are signing, right? And hence, I think the closest that Indian government came there is a convertible note, which is again can be as simple as that as a safe note. Other alternate, by the way, you can have as the CCD or a CCPS round, doing exactly the same thing, going not into much that what are the rights and privileges of CCD, CCPS, but by saying that whenever the next round happens, whatever the right negotiated with the next round, equity investors will be given to the current round investors. So we personally follow a lot of, CCDs, implementing in a safe note, using the CCDs, right? Doing the same thing that, instead of negotiating all the rights, stuff like that, or valuation even, right? We just try to take a discount on a future rounds of equity and the same rights that the future round investor enjoys, So, and then the CCD will convert to equity at the time of the next round. So this is the simplest way to implement the safe note in India today. The convertible note and then the CCD followed by CCPS.
Thanks, both of you for explaining that so nicely. I'm sure they would have a good sense now. And I'm sorry, but we've overshot time a little bit. So I'm going to try and wrap.
One small
You have a question?
On a very, very popular demand. We would like to have the answer again, especially addressing for women entrepreneurs. How can, is there any special arrangement for grants for women entrepreneurs? Quite a few people have asked this question.
Amit, you want to take that one?
So I don't have the list in front of me, but there's so many, maybe, I don't know, maybe.
How many women were there in the Shark Tank season series?
Oh, yeah. So, yeah, means they have, that was one of the, I would say, the criteria to encourage more women entrepreneurship. It was done in the first season as well. Although I wasn't part of the first season team, I can say that with all the due respect for the team which did the work, fabulous, because when we were inviting applications for season 2, there was so much of positive feedback which was coming from women entrepreneurs that, they were coming forward in the sense of the number of applications was more, and they were sharing the how the narrative has changed in their household. The family understands what is valuation and, some jargons which we are used to in the startup ecosystem. So they understand. So that was on the separate note, the kind of feedback which we were getting from women entrepreneurs. So means to answer on what are the options they have. Of course, Shark Tank is just one of the options. And there are many more which have come up as the country is going through this wave of entrepreneurship in the last few years, which I have seen personally. But as I said, I don't have the list in front of me. Maybe I can combine.
So may I suggest that for any of you who want to know a list of women-focused startups VCs or grants, why don't you connect with us on LinkedIn and we'll try and arrange some names and share them with you. Is that fair? So let's leave that for here now. And I think we'll need to wrap up now because we're about a few minutes above time.
We have one.
Is there any other question?
Who has raised the hand? I believe Dolly has raised her hand.
Or yes,
Dolly, you can go ahead and write your question and we'll take that up. No, I think the hand is down.
Okay.
Yeah.
Okay. So thanks, anyone. I think it was a very, very invigorating conversation. So, and I'm sure very helpful for people who were listening in with a lot of tips and trends, which will be handy for them. So thanks for sharing your perspective. It's been a pleasure. I hope it's inspired people. Thanks to the audience as well for joining us today. I'm sure you've enjoyed the conversation and taken away a lot of insights. If you are a would-be startup founder at a concept or early stage, or even at the early pre-revenue or early stages of revenue, and you're wondering how to take the idea forward and convert it into a fundable business model, please log into fi.co and register yourself. We will be happy to speak to you one-on-one. Let me remind you, applications for the New Delhi cohort are now open. This cohort is actually going to be very diverse and interesting as we are creating affiliates in multiple Indian cities like Bangalore, Hyderabad, and also in neighboring countries of Nepal, Myanmar, Bangladesh. So there will be a fair bit of diversity and lots to learn. So please feel free to reach out to me or Mr. E.K. Gupta on LinkedIn, and we'll be happy to reach out to talk to you, or just register on the fi.co and we will be connected. So with that, I once again thank everybody, the panelists as well as the audience. And unless somebody has a final word to say, we will just wrap up here and bid everyone a good evening.
I just want to say thank you for having me here, but to all the audience, please go follow your dreams, go do that startup. you'll find a lot of support exists in the ecosystem, and we need a lot more energetic founders. There's so many problems to solve. I'm sure you'll find one worth solving.
That's a great note to
Nicely said.
finish up on. So thanks, Rahul. Thanks, Neeraj. Thanks, Amit. And thanks, everybody else. Have an absolutely fabulous evening and week ahead. Wish you the best.
Thank you,
Bye-bye.
Rahul. Thank you, Neeraj.
you.
Thanks. Good night.
Thank you. Thank you. Bye.
Thank you, all the
Bye, everybody.
participants. Thanks a lot.
Thank you.
Have a good evening.